The financial system has always followed patterns we believed we understood.
Banks lend, markets price risk, and crises emerge where everyone is watching.
But this time, something is unfolding far beyond public financial visibility.
Not on trading floors, not on screens, but deep inside private deals.
A market growing silently, expanding
Without headlines or daily price signals.
This is private credit, a system operating beyond traditional market transparency.
Loans are negotiated directly, without public markets or continuous price discovery.
No trading screens, no instant liquidity, only long-term agreements and structured deals.
For years, it remained outside attention, quietly supporting companies behind the scenes.
Until its scale reached a level the global financial system could no longer ignore.
After the 2008 financial crisis, banks pulled back and lending conditions tightened significantly.
This created a massive gap in funding, especially for middle-market companies.
And private credit stepped in, filling that gap with speed and flexibility.
capital continued to flow, steadily building a new engine of corporate lending. What began as a niche market has now grown into a trillion-dollar financial force. It is no longer a niche, but a core pillar of modern financial infrastructure. Welcome back to the overview of the macro financial landscape.
And that is exactly when the Federal Reserve began paying close attention.
Not because the system failed, but because it has never truly been tested. This market has never experienced a full economic downturn at this scale.
And no one knows exactly how it will behave when real pressure arrives. On the surface, everything appears stable, almost reassuringly calm and controlled.
Default rates remain low, and cash flows continue to support ongoing operations.
But stability can be misleading when underlying risks are not fully visible.
Many troubled loans are not defaulting. They are being quietly restructured instead.
Extended terms and revised agreements help delay losses rather than eliminate them. Losses are not disappearing. They are simply being delayed through financial structuring.
And delayed losses often return later, with greater impact and less control.
This is where private credit begins to reveal its hidden structural complexity. A system built on flexibility can also become a system that hides its own stress. And when stress is hidden, it becomes far more dangerous to detect in real time. Private credit does not exist in isolation. It is deeply connected to the broader financial system.
Banks provide funding lines, enabling private credit funds to expand beyond their base capital.
Investors supply capital, expecting steady returns from assets they cannot easily exit.
Insurance companies absorb risk through structured exposure to private credit instruments.
Each connection creates another pathway through which financial stress can travel.
When one part of the system weakens, the impact does not stay contained within that segment.
It begins to move outward, spreading through connections that were never designed for stress. This is not a sudden collapse, but a gradual transmission of pressure across institutions.
A system designed for flexibility can bend under pressure without immediately breaking apart.
And that is exactly what makes this type of risk so difficult to recognize early.
One of the greatest risks lies in how losses are recognized within private credit structures.
Some loans do not default immediately. They evolve into more complex financial arrangements.
Payment-in-kind mechanisms allow interest to accumulate instead of being paid in cash.
This creates the illusion of stability, while underlying debt continues to grow silently.
Financial statements may appear stable, even as real risk continues building beneath them.
Some sectors are beginning to show early signs of pressure beneath the surface.
Technology companies, particularly software firms, are facing increasing financial strain.
Rising costs and shifting market conditions are challenging their ability to sustain growth.
Many of these companies rely heavily on private credit to maintain operations and expansion.
And when pressure builds in these sectors, the impact can extend far beyond them. This is why the Federal Reserve has begun closely monitoring the private credit system.
Not reacting to a crisis, but preparing for risks that may not yet be visible.
They are analyzing connections, exposures, and hidden vulnerabilities across institutions.
And looking beyond surface indicators into structures that are not immediately transparent.
The goal is not to predict collapse, but to prevent risk from spreading across the system. Liquidity pressure is often the first visible signal when hidden risks begin to surface.
In private credit, liquidity is limited and access to capital is tightly controlled.
When investors attempt to withdraw, funds may not be able to respond immediately.
Some funds have already begun limiting withdrawals to manage internal stability. These are not signs of collapse, but they are signals that pressure is building. The Federal Reserve does not consider this a systemic crisis at this moment.
The system remains stable, at least when viewed from a broader perspective.
But stability does not necessarily mean safety in a complex financial environment.
It may simply mean that underlying pressure has not yet fully revealed itself.
And historically, risk tends to emerge where visibility is lowest and confidence is highest. Risk no longer announces itself with clear signals or obvious warning signs.
It develops quietly, hidden within structures that few fully understand.
By the time it becomes visible, the system may already be under significant strain. What appears stable today may already be shifting in ways that are not immediately measurable. And what seems contained may already be spreading through unseen financial connections. Private credit is not a crisis, at least not in the way markets traditionally define one.
But it is a system operating under pressure in ways that are not fully visible.
It is a structure that absorbs stress quietly while allowing risk to accumulate over time.
And when that risk finally becomes visible, it often emerges faster than expected. This is not a story of collapse, but a risk that is growing in complete silence.